Welcome to the 2025 Institutional Lending Intelligence Report, an investor-grade map of commercial lending, private credit, syndicated loans, and CLOs. We'll connect market snapshots with AI, regulation, and risk to turn data into strategy. Institutional lending is large-scale credit extended by regulated banks, non-bank intermediaries, and alternative credit managers to corporate, commercial real estate, infrastructure, and sovereign borrowers. It includes credit facilities, term and revolving loans, syndicated loans, private credit strategies like direct lending and mezzanine, plus structured credit such as CLOs, CMBS, and ABS, while excluding consumer lending and retail mortgages. Our scope is global with emphasis on North America, Europe, and Asia Pacific, covering 2020 to 2025 history and projections through 2034. The ecosystem links originators, arrangers, institutional investors, and servicers. To size the institutional lending opportunity, start with 3 layers. The total addressable market is global commercial lending, about $10.9 trillion in 2025. Narrowing to what's most relevant for institutional investors, the serviceable addressable market is institutional and private credit, AUM, roughly $3.5 trillion, up sharply from 2020 as private credit hit record deployment in 2024 and diversified beyond direct lending. The serviceable obtainable market centers on syndicated loans plus direct lending, around $780 billion in 2025, with continued growth projected through 2030. Looking into 2025, institutional lending is set for a cautious recovery. Global loan growth and net interest income may rebound, but inflation uncertainty keeps pricing and duration decisions tight. Demographic shifts, especially digitally native borrowers, push lenders toward digital-first experiences. The biggest accelerator is AI. Machine learning improves underwriting and early warning signals, while agentic AI automates document intake, covenant checks, and servicing. At the same time, Basel IV and the EU AI Act raise compliance stakes. Private credit keeps scaling, increasingly competing and partnering with banks. In 2025, institutional lending competition is being rewritten by bank private credit partnerships. Deals like City Apollo let banks originate and distribute more loans while freeing balance sheet capacity and feeding private credit pipelines. At the same time, record CLO issuance and heavy reset and refinancing volume creates an edge for managers with proven track records, efficient operations, and strong distribution. The market is bifurcating. Global banks dominate large cap investment grade lending, while private credit leads middle market leverage deals with flexible capital and AI enhanced underwriting. Winners bridge both arenas via partnerships, technology, or scale. AI is reshaping institutional lending operations beyond underwriting. First, real-time portfolio monitoring uses machine learning to flag covenant drift, sector shocks, and early warning signals, so risk teams act before losses compound. Second, NLP-driven compliance automates regulatory mapping, surveillance, and reporting, cutting manual effort while improving auditability across jurisdictions. Third, generative AI drafts memos, term sheets, and monitoring summaries, while agentic AI begins orchestrating multi-step tasks, pulling data, running checks, routing approvals, and updating systems. As alternative data expands, these tools improve decision speed and consistency. In 2025, U.S. private credit sees a record high default rate, standing out versus leveraged loans and high yield. The difference is structural. Portfolios are concentrated in middle market borrowers with thinner liquidity buffers, and many deals are covenant light, which can reduce early warning triggers and delay lender intervention. Elevated interest rates intensify the problem by squeezing debt service coverage and pushing more issuers toward amend and extend or distressed refinancing. For banks and institutional lenders, this raises portfolio and systemic risk, especially where exposures overlap with NBFIs. To win in institutional lending through 2028, pair structured credit scale with ESG integration. Phase 1 builds the foundation. Invest in AI and explainable underwriting and fraud tools. Connect alternative data and open banking APIs. Run Basel IV capital impact assessments and launch an ESG credit framework with climate risk scoring plus green and sustainability linked pricing. Next, expand CLO management and issuance to boost capital efficiency and attract institutional investors. Over 12 to 36 months, scale digital origination, automate monitoring and compliance, and lead in sustainable finance.